So inflation and deflation, what's the difference and which one do you think is worse? Inflation is when prices are going up. This is usually measured by something called the CPI, or the Consumer Price Index. So if you see that going up, it means you have inflation. If you see the CPI going down, that effectively means you're in deflation. If it's slowing down, you'll see disinflation. The Consumer Price Index is effectively a basket of goods. So it's measuring the cost of basically where do you live, transportation, food, energy, insurance, things like that. The good part about inflation is generally incomes go up, investment values go up. A negative is that the value of your money goes down. Effectively, your money, the same amount of money can't buy as much as the year previous. Something that's good about low inflation, about 2%, it helps encourage spending now, and your spending is somebody else's income, and their income will then lead to spending, and then they'll spend more to then create more income for somebody else. So that's good, that helps create more jobs. Bad is if you have something called hyperinflation. Imagine you have something that's going up in price, so like bread. So you get paid today a loaf of bread is $1 a loaf. Next week you get paid, it's $2 a loaf. The following week it's $5, $10, $20, $50, $100. So a couple of months ago bread was $1, now it's $100 a loaf. Everything is so inflated. Basically it's a wheelbarrow economy. This happened in Germany and in several other countries where you would get paid, and if you didn't spend the money that day, and if you waited a couple of days, the money was worth significantly less in the course of a week. So that's really bad. So that's basically no one saves any money. Everybody spends everything exactly on payday. In the 1970s, the United States went through something called the wage price spiral. Effectively, we had increased demand. The price of everything would go up. Then workers would demand higher prices because the cost of living was more expensive. That then led to the wages going up. Then companies increased their prices, and now that the workers had more money, they had an increase in demand, which just drove prices up. And constantly the workers were trying to catch up to where they were, but effectively prices just kept going up faster than people could increase their income. The prices of goods to go into businesses would also go up very rapidly. People didn't end up any better than where they were. Even though they would have increased wages, the price of everything would just go up. So it would feel like they've actually made less money because their money is less valuable at that point. The only thing that can really get you out of the spiral is you want to increase the supply to help. So if you increase the supply, the increased demand doesn't necessarily lead to an increase in price. And if the price doesn't increase for everything that you're purchasing, you don't have to have this spiral out of control. The one really good thing about having inflation is that all of your fixed debt becomes easier to pay back. So as your income keeps going up and your debt stays the same, it becomes easier to pay it back. So imagine your mortgage, like the house I bought, was about $53,000 in the 1970s. In 2020, it was over $500,000. So imagine if I still had the mortgage on a $50,000 home, and you make the money that you make today in 2024 versus buying the home for now over 10 times the cost of what it was in the 1970s. One of the reasons why people like inflation, especially governments, think of your national debt level. So as long as your inflation and your GDP outpaces the growth of your national debt, it could stay as a smaller percentage compared to the GDP, or gross domestic product. And this is just an example of what prices would do. So if I have 10% inflation, I go to a certain price. If I have 0% inflation, I stay at the same price. And then if I have negative 10%, that's deflation. So that's going to be a lower price. So what does deflation look like here? So like I was just showing you, prices go down, your CPI goes down, home values go down, your vehicles, your food, your energy, medical, everything goes down. So that sounds great in terms of the cost if you're buying something. But now if you own your home is worth less, you're underwater, you can't sell it, you can't move. The other thing is that your income is going down, so there's going to be more layoffs, people don't have jobs, people can't pay for things. And that's going to keep them from buying more things, which is going to lead to more deflation. I'll show you that in a second. Your investment properties like houses go down, tend to have stock market prices go down. Think of the 1929, 1930s, the Great Depression. The one benefit here is the value of your money goes up. So anybody that holds on to the money, it's worth more year after year. So then that encourages people to not spend any money, which then makes things actually get worse. One good cause of deflation could be increased productivity in a specific item, and this oversupply of that good or service, and that leads to deflation. Think of TVs. I know if you get a 50-inch TV today, it's a couple $100. Now, when I was younger, that would have been several thousands of dollars. Same with computers, cell phones, things like that. Computers today are a couple $100. I remember when they were thousands of dollars. The bad part of deflation, I'm going to go into that deflation loop. This is basically what happened during the Great Depression. So imagine the number of people that want to buy something goes down because they know it's going to be cheaper next year. So they're going to wait to buy. So that means you have lower profit because you're not selling as many items. So that means that company that makes those items doesn't need as many workers. Those workers then lose their jobs. Those laid off people then have less income. Those people that don't have as much income don't have as much demand because they can't afford to buy something. So demand goes down, which then leads to prices going down because nobody's buying a product. So when demand decreases but you have a certain amount of supply, you're going to reduce your price. So you've reduced your price, but then people see you reduced your price, so demand drops further, there's lower profits, you lay more workers off, you have less income, demand reduces, the price goes down, people wait longer, profits drop, people lose their jobs. You can see where this goes. So that's not good. The other bad thing is the fixed debt is harder to pay back. Think about it this way. Let's say you have a house and you have a mortgage, it's a fixed rate. And let's say that that mortgage is $2,000 a month. Now that the house is underwater, you can't refinance that home because you owe too much. You're still going to have to pay back that $2,000 a month or you can lose the property. So what's going to happen is your income might be at $5,000 a month. The following year, after layoffs and things, you might be at $3,000 a month. The following year, more layoffs, more people lost their jobs, as things become deflated and your income goes down. Imagine you are only making $1,000 a month, but your mortgage is $2,000 a month. That's where people lose all of their homes and basically things become worthless. The bank then takes everything. The banks go bankrupt. So it's a really bad thing. So governments will choose not to go through deflation. They'll prefer inflation. Think about it this way. The government also has loans. It has a national debt. It has to pay people back. And if this debt becomes too large, that can't pay back the interest payments, and at that point the government's default, and so that's a bad thing. So that's why governments will always prefer some amount of inflation over deflation, just to keep the national debt as a percentage small as it can. And these are in the trillions of dollars, and they have to pay back a certain percentage each year. And if that national debt stays the same or increases, but the GDP, the gross domestic product, the amount of money that the government brings in the form of taxes on that money, starts to decline, then the national debt grows very rapidly. It can't be paid back, can't be serviced, because it's a very large percentage of what the tax revenue is for the country. And at that point, nobody's going to then lend money to a government. And if the government is basically borrowing money each year, they can no longer borrow money. So that's a really bad situation. So governments are always going to go for inflation or even hyperinflation at some point rather than deflation. Deflation is horrible for that. This video was requested by a viewer. If you have anything that you would like to see, please leave it as a comment below. If you find this interesting and you'd like to learn more about how to make more money, how to save, and how to invest, please subscribe. This channel has a lot for you. Thank you for watching and have a great day.